So let's finish up the discussion on business combinations and then look at where we're going next in the class. So the first thing you do is forecast cash flows of the target company. You can look at that historically, very similar to what we did with Project 1. You look at the historical data, margins, turnover. You got to come up with the right discount rate. A lot of people use the capital asset pricing model, so the risk-free rate plus a risk premium. You then value those cash flows, get the intrinsic value, and then you want to bid a price that's below the intrinsic value. So the value you come up with is $500 million, then you might bid $400 million. And obviously the other side, the firm that's selling, their investment banker is going to say, hey, it's worth 600,000. So you say, hey, we bid 400. The other side say, hey, we want 600. Maybe the stock's currently trading for 350 million. So you're bidding 400. And you may be bidding 400 when the market's trading 350. I mean, if you think about this, let's say the market value, the market price, let's say it's 350. Your intrinsic value, let's say is 500. You bid 400. Now, why did your intrinsic value come out higher than the market value? It might be that the firm is just undervalued. It might be that your intrinsic value assumes that you get rid of management or you have synergies. So your intrinsic value looks at what you think the firm is worth after you make all your changes. You don't want to bid 500 because if you bid 500, you're getting exactly what you think the firm's worth. There's no upside. So you bid 400 and the market's trading for 350, so maybe a 12-13% premium. And most firms, when they bid for another firm, they bid at a premium above the current market price. So the other side might say, hey, this firm's worth 600, 550, 600. Their investment bankers are going to try to push that value up so you get a higher bid. But that's the way the game is played. And it's an interesting process. I think it would be fun as a career, but also very stressful. Usually when you're in the middle of a process like this, you're just not going to go home. You may be up there till 1 a.m., 2 a.m., 3 a.m. in the morning and get there the next day at 7 a.m. or maybe you don't go home at all. The discount rate, we've already done that. WAC, CAPM, so you already know how to do that. So yeah, we've already done this, so there's no issue for that. We won't talk about arbitrage pricing theory. And then how do you actually value the firm? We're going to talk about this later in the class. We're not going to use a free cash flow model, but this, if you're a finance major, if you interview with investment bankers, this is the model you would learn. So again, if you're really interested in this, let me get you an Excel model that does exactly this, and you can work through the math. We're going to use these two models, the constant growth model and H model, later in the class, so we'll get to this. Determined growth rate, we'll talk about this, so don't worry about that. So we'll get into this. I put Porter's 5 forces up there. We might talk about something related to that as well later in the class. But we'll get into that. You definitely want to know Porter's 5 forces before you graduate. So hopefully you'll have at least one class. If you take my security analysis class, we do Porter's 5 forces in there. I'm sure your capstone class will do it, and some of your strategy classes will do it. Extremely important theory. I like, in addition to this, I like the concept of an economic moat. And we might talk about economic moat. It's closely related to Porter's 5 forces. It's something that Warren Buffett at Berkshire Hathaway likes a lot. But it's a very similar theory. We might get into it. I have an entire presentation on economic moats, and I tie it into Porter's 5 forces. So it depends. Right now, everybody knows Porter's 5 forces. So if you bring that up in an interview, they're not going to be that impressed. They just assume you know that. Economic moat is the new catchphrase that if you bring that up, they'll be more impressed. So in an interview, I would try to work them both in there, but try to bring up the concept of economic moats. Hopefully we'll have time later to walk through that theory. And in comparables, we're going to talk about comparables. So we'll do that here pretty soon. Relative value versus intrinsic value. So we'll get into that. So don't worry about relatives right now. So there are some adjustments you might have to take for the firm. We may not get into these, but there are some things like, do they have a pension plan? Do they have employee stock options? If you're valuing a private firm, you really can't, you don't have a stock price, you don't know what the intrinsic, you don't know what the current market value is. So it's a much more difficult. I've done some private firm valuations. There's a friend of mine who has a consulting firm, and I've worked with him on some projects where we value the firm that was private, and it's tough. You come up with what you think is reasonable. So we'll talk through some of that. We're going to skip this, but this just shows you how you can figure out the price relative for a firm by looking at, so you got a private firm, so you look at price relatives or competitors and try to figure it out. We'll get into that later when we do price relatives. We're not going to do replacement cost method. It's really difficult to do. Replacement cost method says, how much would it cost for me to build this firm from scratch today? Very difficult analysis to do. Something, if you're interested in this industry, something you might look up is the concept of a Tobin's Q. So I'll just leave that as something you can look up. That's very much a replacement cost type of analysis. So if you're interested in investment banking, then you definitely need to know, the stuff I've been mentioning before, the free cash flow model, Porter's, economic moats, but Tobin's Q is another one. All the different strategies we talked about, how management protects itself, golden parachutes, and all those kind of things. These are all things that if you're going to interview with an investment firm, investment bank, you need to know better than most undergraduate students would get in their normal coursework. So you might use multiple approaches, and you might try to find maybe the average of all of those, or look at the range and try to get a sense of where you want to be, and then maybe you bid at the lower end of the range of evaluation, so you have some protection on the downside. One thing that's key here that you also might want to think about here is the concept of a margin of safety. That's a very famous term. Benjamin Graham, very famous writer in finance, he came up with that phrase, margin of safety. Essentially what it says is you value the firm and you value it in a range. Maybe you value it from 300 to 600, and you try to get the bid at 300 so that if you're wrong, you don't have much downside. So you have a margin of safety. So that's another term that you would want to know. So I'm trying to give you the catchphrases just in case there's some investment banker hope to be's out there, which a lot of finance students, that is their goal. These are some terms you definitely, come to me and I'll give you the whole litany of terms you need to know to be an investment banker. The last part of here I'm going to go through really quickly. Structuring this, we will not cover this, but you might have a class where you cover it. Do you buy the firm with cash? Do you buy it with stock and cash? Do you just combine the firms where there's no transaction? So you can read through these, but you can use the stock, you can use cash, you can borrow money and do what's called a leveraged buyout, and you borrow money and you buy it. There's different ways to do it. So I'm going to skip through those. Mergers not necessarily have to involve cash or stock. You simply bring the two companies together, but it can be quite complex. And then leveraged buyouts, we were looking at that earlier. It's a lot of times it's management will borrow a lot of money and buy out the firm. You've seen that with a firm like Dell Computer, where Michael Dell decided to take his firm private. So he bought it out, used a lot of debt, and now it's come back public again. You can go public again. Burger King did that. So it's not real common, but you will occasionally see a firm that's public go private, get fixed, get whatever they need because they don't want the daily price moves that you see in the market. Fix the firm, go back public again, and see. I haven't really been watching Burger King. Dell, I've been watching. They finally turned a profit after having huge losses. and so they're finally making money. They have tremendous revenues. Their revenues are like $90 billion. So Michael Dell just felt like the market wasn't giving him the credit. He wanted to take it private so he could do some stuff that stockholders don't generally like, but he thought it was the best for the company to go private, get it out of the press, out of the daily stock move. Um, so that's all I'm going to do for leverage buyouts. Other things you can do, you have to look at the legal form after the acquisition. You have to consider tax considerations. There are accounting rules, and you have to be really careful with counting. This is something you're somewhat in an unusual, kind of awkward place in your business career, business education. Whereas we have GAAP rules and we have international rules, IFRS, and then you have GAAP, US GAAP. You may have to come back, especially you accounting majors may have to come back, and you might want to wait for your master's. This might be one argument, to wait a few years for your master's if you're an accounting major, to wait until international standards really get solidified. We have a lady named Cheryl who's a doctor, accounting professor at UTSA. If you're an accounting major, I would really try to take her class because she's an absolute expert on international accounting standards. And sorry, I misspelled the word accounting there. So, but there's rules. I remember when I took advanced accounting, undergraduate, these different M&A accounting rules were in the advanced accounting class. I thought advanced accounting was easier than intermediate accounting, so I thought they were actually pretty simple. But there is some complexity there, and accounting textbooks it's not too bad, but in real life, yeah, it can get pretty messy. So here's some other rules about the accounting. Alternative strategies, you don't necessarily have to do M&A. There are other ways you can do it. What you're trying to do is find a partner. So if you can somehow share outlays. So think about some of the auto manufacturers. They're actually, some of their cars are the exact same car. They just put a different body on it. Some of them are sharing the autonomous vehicles and electric vehicles. They're sharing that development so they can share the cost. So they're doing essentially a partnership, a joint venture or a partnership as an alternative to a merger or acquisition. It's a little less complex. You're not stuck with the firm forever. If anything goes wrong, you can end the partnership and you don't have to unwind anything. So you see that. I know some firms that want to get into China, and it's really difficult. And same thing with India. So rather than going into China or going to India, they instead find a good Chinese company or a good Indian company and do a joint venture with them. And sometimes that can work a whole lot better. It gets you around a lot of regulation and red tape. So, so joint ventures are an option. Partnerships, strategic alliances. Yeah, there's other approaches. Licensing can be really, really good. So rather than merging two companies, you just give them a license to your product and allow them to sell it. So yeah. And then what about international? I don't want to get into this too much. I don't think we have any international business majors in our class. To me, international business is essentially U.S. finance, U.S. accounting, but then throwing in things like currencies and government regulations. So markets around the world have become much deeper, more liquid. There's a lot more cross-border investing. Markets have become more integrated, although I think what's happening here recently is starting to maybe unwind that a little bit. So it makes us more vulnerable to a global crisis, as we're seeing. Banks are expanding their services, so it works. I won't get into just developed versus emerging countries, but there are countries that are very, very developed, like the UK and France and Australia, and there's countries that are emerging, like Brazil and China. And so you can read this criteria. The Standard & Poor's has their criteria, and it essentially comes to how developed are their markets. So this might influence you where you want to do your mergers, your acquisitions. You want to make sure you're in a market where they're friendly to U.S. capital, that your capital is not going to get stuck in a company in the country and you can't get it out. So I'm going to skip through those. So what are the motivations? Again, you see that diversification. Geographic diversification, industrial. It helps accelerate your growth because you get into a fast-growing country like India or China where you don't have to build from scratch. maybe the industry is consolidating. We've seen that in the steel industry where it's consolidating, and China's really starting to dominate certain industries, where it's precious earth or steel, or even artificial intelligence. You might get access to certain labor or raw materials. You might be able to leverage your intangible asset better. So you've got a patent, and you want to get it around the globe faster. Again, we talk about tax liabilities. That's the reason U.S. pharmaceuticals have been merging with European countries to get a better tax treatment, although that's starting to disappear. Regulators in both countries are really clamping down on that. It might help you avoid quotas and tariffs. That's obviously an important issue. Several companies, U.S. companies, have been moving out of China in order to avoid some of the recent tariffs there. It might get you closer to your customer. So a lot of reasons, but you have a lot of issues, political and economic issues, excess regulations, confiscatory tax policies, restrictions, currency problems, employment issues. It's very difficult in the European Union to hire more than 50 people. The regulations become almost impossible. Expropriation of assets, that's been a big issue in Venezuela and Russia, in certain countries where at any time the government says, you know what, I really like your company, we're going to take it over. And then you just have unrest. There's less civil war, less social unrest today than there was 10 years ago and 20 years ago. It may not seem like it if you watch the news, but the world is much less at war, much safer today, but it's still an issue. So you have corruption issues. There is an index that it's out there. It's called Ease of Doing Business, where they rank every country, how easy it is to do business in each of those countries. So if you're doing business with another company, you're thinking about a merger, you might check and see what their score is. Cultural issues. You got to see what the country's view is about takeovers. Europe right now is very negative on U.S. companies coming into Europe. Accounting issues, disclosure issues are always there. So everything is essentially the same, except you have to add extra risk premiums. So if you're a finance major, here's something you can look up. Dan Moderen is a professor from New York School of Business, and he actually publishes for free on the internet his country risk premiums. And his process is pretty good. So if you're valuing a company, you could actually just use his risk premiums for your analysis, and you would probably be in pretty good company. He does a very extensive analysis of each country, looking at the quality of the government, how much debt the country has, how it's free trade, its currencies, those kind of things. And so that's something you could definitely look up. If you have a project, if you have a capstone project where you're looking at a country overseas, Dan Moderen's spreadsheet would be really helpful there. So I'm not going to go through that, but yeah, you have to make an adjustment for risk. And you have to, adjust CAPM. You got to adjust your beta for the global issues. So that is it for mergers and acquisitions. Sorry I couldn't give you more updated numbers. I doubt I'll be able to get to the Bloomberg machines before the semester is up. But so we talked about leverage buyout. Where we go next is my favorite topic. Risk management. We could spend the next 6 years on risk management. I love this topic. I teach a risk management class. It is my favorite class. I'm not sure it's the favorite class of my students. I go pretty wild in that class. We cover the basics, and then I challenge the basics, and I show some alternatives. We're going to keep it fairly simple. I'll give you a little bit of introduction. The next couple of classes, you do have an Excel application on risk management, and I told you that economic value added was maybe the easiest Excel application. I might be wrong. I think maybe the risk management one might be the easiest of all. It's a fairly simple, straightforward calculation. So we'll work on risk management next, my favorite topic. So hopefully that doesn't mean I'll be talking a lot faster. I'll try to keep myself calm during that session. So that's it for class 21.